Good morning, everybody, and it's great to see you here for our very topical webinar this morning on cryptocurrencies and whether they're for you. We will be just taking questions at the end, so if you've got a question, just click on the chat box and type it in so you don't forget it. And at the end, we will address the questions. And I've definitely got a few of my own questions. So hopefully, we can allow 10 minutes or so at the end of the session. So Joe Antonetti, our senior advisor, has also joined us this morning, together with Tim Yule, Max Pasella, and Mike Young from Mason Stevens. So I guess what we've really wanted to conduct this webinar for is to give you information and an understanding of cryptocurrencies and whether in fact they have a place in your portfolio, and also a bit of a feel for perhaps what we're thinking in our house view. We've had lots and lots of inquiries around cryptocurrency for quite some time, and we have released a few research reports and things along the way. But it's so topical now that we really felt that we could give you a lot more information, and it's fantastic to have brilliant resources extended to us from Mason Stevens. So without further ado, I'd like to just introduce you to Tim Yule, who's sitting at the far end of the table on the video there. Tim joined Mason Stevens in 2015, and he has over 20 years experience leading investment banking and wealth management in firms such as UBS, Royal Bank of Scotland, Perpetual and Westpac. We love working with the guys at Mason Stevens, and Tim's got a deep experience in fixed income, investment markets and wealth management, and he's a key contact for us here in our portfolios at WealthMed. So I'll hand over to you, Tim.
Thank you, Carolyn, and it's lovely to have the opportunity to speak today. I'm really only going to talk for 1 or 2 minutes just while we're getting the slides set up. I really wanted to welcome everybody to today's talk. I think blockchain and Bitcoin and cryptocurrencies is really one of the half a dozen emerging technologies that we're seeing, which we believe will really act as a transformational catalyst for the global economy moving forward. And in particular, when we combine demographic trends, emerging markets, and these emerging technologies, it's really becoming an incredibly powerful way in which economies can transform themselves. So it's worth looking at and understanding, even if it's not from an investment perspective, just from an economy perspective more than anything else. WealthMed and Mason Stevens obviously go back 10.5 years, 11 years since day one. WealthMed's a wonderful supporter of Mason Stevens, and we like to think we can support WealthMed as they navigate the investment universe and the landscape. For clients of WealthMed, you're obviously in incredibly safe and competent hands with some of the best advisors in the Australian market today. And Mason Stevens makes no bones that we will only deal with advisors who represent the very best of the Australian financial services industry. So congratulations for working with WealthMed. Today I've got 2 of our team members in the room, Max and Mike. I've got way too many grey hairs to be able to articulate technology in the way that I think it deserves. Max and Mike form part of our equity investment and analysis team, and their role is really to identify thematic trends, underlying securities, and do it in a way that makes sense for a high net worth investor in the Australian market. So unlike an analyst sitting in an investment bank in New York or London, they are solely focused on ensuring that the portfolio solutions, the technologies that we back, are fit for purpose for a domestic investor in the context of an Australian portfolio. So, Max and Mike are one of 23 staff that we have access to within Mason Stevens, and complementing them, we have another 16 analysts that we have access to in New York. and those New York analysts in particular are entirely focused on emerging technologies and transformational change across the market. So sit back, we'll listen to Mike and Max as they take us through what is really a primer for Bitcoin and all of the noise and really the technology that underpins that, which is the blockchain. And so once you've got a good understanding of blockchain, that will then act as a catalyst for whether Bitcoin is an area where you want to invest. And I should say, at the end of this session, I think Max will be talking about 1 or 2 ways to get some broad-based exposure to blockchain. They are very different in terms of what you're buying, what you're investing in and why. And so we'd encourage you to have a real deep consideration as to why you might be investing in. You know, I was on a bus at the back of Sydney and there was an advertisement for that bus, on the back of that bus saying, if you have seen Bitcoin on the back of a bus, it's now time to invest. And some of us who've been through a few market cycles would suggest that that is precisely the wrong time to invest. So let's unpack that. I'll hand over to Mike and Max, and hopefully we can share some information for you all.
Thank you for the warm intro, Tim. Good morning, everybody up there in Brisbane. Thank you again for having us. The way that we thought we'd talk about this is there's a lot to cover in quite a short time. Is I will give you a brief sort of intro of what a blockchain actually is, because that term is thrown around a lot without a lot of clarity. I'll hand over to Mike, who will sort of break down the meat and potatoes of how does it work, what are the use cases for it currently, and what are the future use cases. I'll then come back and over the Senate talk about the risks, and then we'll touch on some ways that you can get exposure through your investments in WealthMed into this budding market sector. So just making sure, I assume that everybody can see the slides okay. What a blockchain strictly is a peer-to-peer ledger technology. Essentially, it acts as a digital database. It holds transactional records going back historically and builds upon itself. Mostly right now, you can see it as a ledger for transactions, the same way that you might see a transaction report in a traditional equity portfolio. To break that into simple terms, it's a data structure. It is a chain of records where the blocks are the links in the chain. And much like a strong chain, as you might see in the real world, each of those links is strong. They intrinsically tie together and form the foundation of the greater whole. And as more blocks are added, fundamentally the chain becomes stronger and more complex. Mike will talk about that a little more. Importantly, and part of the appeal behind cryptocurrency and blockchain in general, is that there's no central authority. So no one has autonomy over how this data structure works. It's more of a meritocracy than anything else in most cases. They can't be changed, and that means that they are transparent. And you might think that through the transparency of everybody being able to see what you're doing, that might make it a bit insecure, but it's actually the opposite. When you're looking at a blockchain, you can't see what people are doing in that exact moment, much like if you're using a messenger app. You can see that someone's typing, but you can't see what they're typing. So you can see that there's activity going on throughout the chain. Certain chains, you can see who those parties are, but until they complete the transaction and the block is created, you can't actually see what they're doing. But what that means is that once it's there, it's immutable. So you can't change your historical record. Everything there is plain for the market to see. So you can very quickly go back and see if there's any transactions that might be linked to something adverse. You can go back and see if someone said they're going to do something, for instance, for your trading services, and they deliver a transaction that's not what you agreed upon. It's very obvious. It can't be hidden. Besides transactions, you can handle contracts, deals. We will touch on non-fungible tokens, probably a topic for next week, but you can actually process pieces of information separately across the blockchain. And basically, if you can picture anything that becomes digitized, it can fit into a blockchain transaction and become a block itself. First created in 2008 by either a person or a group of people who go by the name of Satoshi Nakamoto. However, that origin remains a mystery. Mike, I might hand over to you.
Thank you very much, Max. So now that we've talked about broadly what blockchain is, how exactly does it work? So to understand how blockchain technology functions, we'll use the example of Bitcoin. which is the most prominent use case of blockchain at this time. So as Max said, it was created in 2008 with the intention of creating a trustless monetary system, removing intermediaries currently required to make financial markets function. It carries the same characteristics as money, being durable, portable, fungible, recognizable, scarce, and visible. It's based on mathematics as opposed to relying on physical properties like gold and silver, or relying on central authorities like fiat currencies. It's decentralized with no one person or group of people having the ability to change anything which occurs on the blockchain. It's transparent and it's also non-reputable. It can be used between individuals or entities who have no basis to trust each other. It can be used to issue, transfer, and record ownership of Bitcoin on the blockchain. So now the technical part on how how Bitcoin itself works. So firstly, in order to transact in Bitcoin, you'll require the following three things. So your own unique 34-character key, or an address, as they're also referred to as. This is made up of a combination of random letters and numbers, the recipient's 34-character key address, and the amount of Bitcoin which is to be sent. So once all this data has been inputted, it's uploaded into the blockchain, and it's created and sent to every node in the network. Now, these nodes are also referred to as Bitcoin miners, as you might have seen in the news. And these miners then validate the transaction to confirm its authenticity. So by that I mean the miners will ensure that the sending client has the Bitcoin to send and that the addresses are valid. The nodes who validate these transactions are then rewarded for their efforts with Bitcoin. Now, the nodes are selected on the basis of computational power. So by that I mean you have a big pool of miners, and only a few of these miners can be selected to validate each transaction. They are tasked with a complex algorithm to solve, and they use their own computational power to solve these algorithms. Now, think of these algorithms as a series of blocks with combinations. The more computational power you have, the more times you can attempt combinations in the locks, and the more attempts you can have at picking these locks, the more likely you are to succeed. So in the end, the person with the most computational power is the most likely to succeed. Once this is all completed, the client receives their Bitcoin, and the block is added onto the blockchain and it is left there forever. Now, what can the blockchain be used for? So currently, blockchain technology is used primarily in cryptocurrencies. These cryptocurrencies have three main properties which they form. So the first is a medium of exchange, and a store of value, and also for smart contracts. So cryptocurrencies are currently used to a limited extent as a medium of exchange. Those cryptocurrencies which exhibit properties of liquidity and store of value characteristics are those which are used, like Bitcoin, Litecoin, and Ethereum. Currently, they're primarily used in international retailing transactions. So they're beneficial in this sense because they're able to circumnavigate expensive transaction costs and also lengthy settlement processes. However, it must be noted that currently their usage is not widespread given their volatility. Now, cryptocurrencies have also been used as a store of value. Investors have sought to park their funds in cryptocurrencies to act as a hedge against traditional financial infrastructure. I think it's pretty well summed up this mentality by venture capitalist Chamath Palihapitiya, who coins Bitcoin as a schmuck insurance. So protecting against the deteriorating value of fiat currencies from fiscal and monetary policy. Whether or not that actually comes true or not is another question, but that is his perspective. Now, the third use case is smart contracts. So smart contracts are agreements built into blockchains with their terms and conditions written into lines of code. So these smart contracts enable blockchain technology to be used in a multitude of ways. The most prominent use case of smart contracts currently is decentralized finance, which is also referred to as DeFi. Now, DeFi provides a myriad of financial services, many which you would use in your day-to-day activities, except these would be off the blockchain, obviously. So this can involve borrowing and lending money between individuals, allowing people to remove counterparty risk, which is offered by banks. It can also involve insurance. Slide next. One use case which is currently on the market is flight insurance. So insuring against flight delays. This is provided by EtherRisk. So on this website, you can enter in your flight details, then you enter in your premium, and it lets you know the level of cover you would be entitled to should your flight be delayed or cancelled. Now, in this process, once you've entered all this and paid your premium, the decision on whether clients are paid out or not is determined by a third-party data service, also referred to as an oracle. Now, these oracles upload external data into the blockchain, which in this case would be flight departure records, to automatically decide whether or not a client will be paid out. In this whole process, there is no need for an intermediary or any real human interaction, apart from the starting user entering in their premium and their flight details, and then just entering in the receiving address for which they would receive their payout. Now, this is a quite limited application of blockchain technology now, but there are massive future use cases of blockchain technology. As with most revolutionary technologies, it's going to take a lot of time until we see it fully integrated within society. They can be used in a multitude of ways, including identity verification, healthcare records, supply chain management, property records, capital markets, and much more. However, we believe that the most exciting use case of blockchain technology is central bank digital currencies, or CBDCs. Now, CBDCs are blockchain-based tokens which represent fiat currencies in a digital form. They are centralized, issued, and regulated by central monetary authorities. They are essentially physical cash, but in a digital form. So when we're looking at sort of the difference between a CBDC and cash in your bank account, we first have to examine the difference between physical cash and cash in your bank account. So physical cash is a legal tender. No one can take it from you legally without having a reason to do so. The cash in your bank account is not legal tender. It's more a promise that the bank will provide the funds you've deposited in the future should you ask for those funds. As banks currently operate under fractional reserve systems, banks will only typically carry a portion of their clients' deposits in cash. And therein lies the difference between CBDCs and cash in your bank account. They're more efficient and convenient than physical cash. And it would make it easier for governments to collect tax, pay helicopter money, and it would also make things more efficient and convenient for the end user. Now, another example of how CBDCs offer value is through international capital transfers. So currently, should you want to transfer money from your Australian bank account to an American bank account, it might have to go through multiple banks depending on your bank's relationship with the SWIFT payment system. This process could also take a number of days, given all the backroom operations processes which were required. But through the blockchain, you would be able to transfer funds from a US CBDC account to an Australian CBDC account, depending on the agreement between the two central banks. It would go through the blockchain and it would occur within seconds or minutes. So obviously you can see a big sort of benefit to international capital transfers and making capital flows more fluid around the world.
So I might just jump in there. The example that's on the screen now is one that we're seeing live today. So in this example that Mike's put together, transferring US dollars into Australia has required effectively 4 institutions to be involved. So Bank A is the sender's bank, Bank B is the correspondent bank who has a relationship with an Aussie dollar institution, Australian dollar institution. And so Bank A sends US dollars to Bank B, Bank B sends US dollars to Bank C, who then converts it into Australian dollars and sends it to Bank D. In the blockchain example that Mike has given, there are only 2 players in that chain, and that is Bank A and Bank D. So even just from a basic efficiency perspective, there is incredible efficiency gains that can be achieved through using very basic blockchain technology. The other interesting example is if we think about what's going on in the United States at the moment, where Joe Biden's just put through a $1.6 trillion stimulus, and he is physically mailing hundreds of millions of checks. What's interesting is there's a huge amount of Americans who actually don't have bank accounts. So he's physically mailing hundreds of millions of checks to those institutions, those individuals who are subject to a $2,500 to $3,000 stimulus. In the blockchain world, and again, we're seeing this taking place in some emerging economies like Vietnam, like China, where payment systems are actually delivering digital currency direct to consumers. So the central bank of China has created a digital currency. You download an app on your phone, and if the central bank wants to provide you with a $2,500 stimulus, you don't get a check, you don't get a credit into your bank, you get a digital yuan credit on your smartphone. And so there are, and again, both of those examples are live and real examples. So imagine the efficiency dividend that you can achieve out of Joe Biden sending $1.6 trillion of monies into America's most needy in real time, and literally it would be in real time, as opposed to a 2, 3, 4 week delay. Millions of checks literally being lost, never processed, or processed a year later. So it's these kind of transformational examples that I think are really incredible when we start thinking about blockchain. Sorry, Mike, back to you.
Thank you, Tim. So we've just talked about, what are the future use cases? But of course, we've got to step back and go, there are some risks, as there are with everything. Probably the most relevant to what the guys just talked about is the potential for user error. So in the example before, if Mike works at NAB and I tell him I want you to send 100,000 Aussie over to Credit Suisse in the US, and he makes a mistake, there's recourse there, there's liability that can be done, they have public liability insurance. Generally, they're protected by an insto, and therefore us as a consumer are protected as well. Same as if I tell NAB to send something to CPA and they do something wrong, there's ASIC or the financial ombudsman to step in. In a decentralized process where there's no one commanding authority, you don't have that form of recourse. There's massive potential for user error. If you get your key wrong, if you send the wrong amount of Bitcoin, you can sue them. In fact, if you send one, you might send 2 Bitcoin instead of 1. If Musk tweets about something in the minute that you've done that, then that might be a couple of $1,000 error. So as a consumer, you're offered greater freedom, but with that comes greater responsibility on you to be accurate, to keep records correct, and that can lead to a tremendous amount of user error. Same thing, we've heard stories about this all the time. There's a gentleman here in Sydney who's pleading the local council to go through their tip because his hard drive, which had his Bitcoin key and has about $200 million worth of Bitcoin on it, is currently sitting somewhere at the bottom of the garbage pile. So if you don't keep track of your key, if you lose it, if it's saved in a hard drive, for some reason that blows up, then your store of value is now disappeared into the ether. If you don't have that key, it more or less sits there as an orphaned coin. So that's a pretty prevalent risk. It's something that will fall down to the individual as opposed to some kind of body that can manage that. If we go a little deeper into that, there's worries about vulnerabilities in the blockchain. So if everything's digital, can it be hacked? The question to that probably is, well, can a bank be hacked? The answer is yes, we've seen it done. Blockchain is an interesting case where, because of the validity that each chain needs to validate a transaction. So Bitcoin needs proof of work, hence the miners that Mike was talking about. Ethereum needs proof of custody, which is slightly different. Basically, you need to prove that you actually hold the coin. There are certain checks and balances in place. Also, because a blockchain cannot be changed historically, the only real target is the moment-to-moment transaction, whereas a bank account or a bank history, those processes can be changed retroactively if they're hacked. So it's probably a concern that won't arise unless we have some significant advancements in computing power, i.e. quantum computing or something like that. Looking from an environmental perspective, blockchain, Bitcoin specifically in this case, has the potential to be very energy intensive. So here you can see that Bitcoin already is using more energy in the country of Argentina. Something to keep in mind about, as a blockchain, particularly as Bitcoin builds, the more market cap and the more people involved in the transactions, the more miners get involved in the process because they want to slice that pie. But the way that the Bitcoin blockchain is set up is that the more miners there are, the more difficult the algorithms are to solve for each transaction, which means the miners need more computational power. So we're not going to see a linear increase in power consumption as Bitcoin gains market share. We're going to see it exponentially increase. So it can work its way up this graph very rapidly. I suppose the flip side to this is Bitcoin miners tend to go with a surplus power, which often means they're going somewhere like hydroelectricity based in Canada. They might go to somewhere where there's surplus coal-fired power plants in remote regions of China. So there's a bit of a trade-off there between, of course, Wall Street requires power, gold mining requires power. What we're seeing now, though, is the environmental risk is not that, Bitcoin's just another power contributor, it'll offset it. At the moment, because Bitcoin doesn't have that much market share, we're not seeing it offsetting, we're just seeing it add to global power consumption. So if it takes market share and that money comes out of requiring computers to run on Wall Street or requiring a deep drill miner for gold or silver to operate, then it offsets itself. But for now, we're just seeing it added on top. So for those who are ESG conscious, that's something to keep in mind. To avoid sort of sustainability concerns, there may be processes in the future where Bitcoin mining is made less energy intensive. Something to keep in mind from a blockchain perspective, as well as we'll touch on this next week for Bitcoin, is that around 80% of all Bitcoins have already been mined. So at the current rate and the current rate of growth of miners, the last Bitcoin will be mined at around 2140, which means most of the gold has been taken from the stream, so to speak. So from there, we're going to look at, okay, well, what happens now? How are miners rewarded? What's the energy consumption going to be like? So those are risks, not so much presently, but future risks that we need to take into account. Beyond that, it's probably more coming down to the immediate risk of being the tokens, which we'll discuss next week. But of course, with any emerging currency, there's regulation risk. There's risk that will be accepted in some places, not others. So we just need to keep in mind that this is a rapidly evolving and quite dynamic asset class, and you are investing in something that's pushing the cutting edge, but we don't know what's just beyond it because this is world first. Now, how do we get exposure to it? So this is something that through your investments with WealthMed, you'll look through and go, okay, do I want to just buy an ETF? Are there companies exposed to it? A popular opinion in the house is that, at least for blockchain, investing in an equity that has exposure to Bitcoin might mute some of the risks associated with the volatility and this uncertainty around buying a physical coin. So there currently exist a couple of blockchain ETFs which track companies that get a certain percentage of their revenue out of being involved in blockchain creation, blockchain maintenance, the servicing of blockchain computational technology. Basically, if they're involved in the sector, they can fit into here. So the ones that we've got here are the reality shares, Next Gen Economy, or BLCN, and then you've got the Amplified Transformational Data Sharing ETF, or Block. Both are listed in the US, denominated in the US. Block in particular has names that people will be familiar with, including MicroStrategy of Michael Saylor firm. So there are some big names in there that aren't necessarily buying Bitcoin directly, but you still are getting exposure to that growth. And you can see from the growth of the chart, it's not as volatile, but it's still showing the sort of upward and to the right momentum that the major cryptocurrencies are showing. The next potential, and one that's probably a little more traditional and fits more comfortably into an equity exposure at the moment, is PayPal. So PayPal are positioning themselves to be the center of blockchain development. They're currently able to trade Bitcoin just between other PayPal accounts, so you can't take it off. It's sort of Bitcoin held in a little separate universe while still on the main blockchain. They have 286 million users worldwide, and those, I think, just within the US for now, but they're pushing worldwide, can trade, well, pardon me, not trade, but pay for goods and services in Bitcoin. With that, they also have their own blockchain tech behind them. After a partnership with Curve, who are a digital asset specialist, they just bought them for $200 billion. That's immediate exposure. Probably the long-term play, the more exciting play for investors around PayPal, is that they're positioning themselves to be at the very forefront of adopting a central bank digital currency, ideally in the US, where they're domiciled, but elsewhere PayPal have strong positions in Asia Pacific and Europe. So they're really building out their digital and human infrastructure by building out teams here to be able to facilitate payments, to be able to facilitate custody of central bank digital currencies once they come into play. So that's a sort of forward-looking potential exposure to that development of the financial sector. Those are sort of three. There are obviously myriads of ways as more blockchain companies come online. But for now, those are some broad-based, future-looking, not terribly controversial exposures that you can get to blockchain.
Thank you. Well, that's it for the formal part of the proceedings. Open to questions or comments. Carolyn, we might throw back to you, and hopefully we can hear some questions.
Yeah, well, I've got a question. I'm just wondering how disruptive this might be to the banking system in general. When you consider that banks' business model is to take a percentage of the money that's moving around the banking system for their profits.
Do you want to talk?
I'm happy to talk about that. So what you'll find is that most banking, well, not most banking systems, but some banking systems still date back to the 70s, so they're still very antiquated. And there's been some movement through mostly the majors to get a more up-to-date system, but we are still sort of looking at the bank's adoption of blockchain. So because blockchain is so heavily associated with cryptos, there's a certain societal and sort of political resistance to it. Some banks are sort of reopening. Goldman Sachs, JP Morgan, Credit Suisse have started either new or reopened their crypto trading desks. With that, we might start to see some sort of embracing of building their own blockchain, or, and this is a potential future exposure to blockchain companies, there may be blockchain leaders out there who they'll just purchase their blockchain infrastructure from, same as a service provider, like they might buy a system off Cisco at the moment. So how disruptive will it be? There's a potential that it will take share away from banks and go to the individuals, but we also have to consider the political influence and sort of monetary power that's rolling around the global banking system. So it's probably more likely that what we see is an adoption by banks to take over the blockchain process, to have the best, implement more security around it, implement more user friendliness, and try and keep their market share by just upgrading their technology rather than ceding it to individual transactions.
And I think, just to Max's point, this is where we need to draw a sharp distinction between blockchain technology and a Bitcoin or a cryptocurrency. So blockchain technology is currently being in the process of being implemented through places like the ASX. It will be integrated into banking systems more broadly. We know that a number of central banks around the world are using it for creation of digital fiat currencies. Where that contrasts with a cryptocurrency is currently cryptocurrencies are completely unregulated. There's no central authority. There's no controls in place. And so for a bank to embrace blockchain doesn't necessarily mean they're going to embrace cryptocurrencies. I think once we start to see regulators step into and regulate cryptocurrencies, that's when you'll really start to see the rubber hit the road in terms of what's possible out there in that exchange of value. But the underlying mechanics, I think, it's already rolling out across multiple industries. today, and banking will be no exception to that.
And I've probably got another question that sort of follows on from that, is that in the example that you gave where you were moving money from one currency to another, is it a similar sort of structure in terms of different value system for different country currencies as we do have now through the foreign exchange rates and fees for doing that?
It's incredibly simple to do compared to, and we have done this at our desks here. So we have one screen with 4 windows open, which is 2 Bitcoin wallets, and then an Aussie dollar bank account and a Vietnamese dong bank account. And we transfer money within a minute between Australia and Vietnam. The traditional way of doing that is probably a 1 to 2 week process at best, because Vietnam it's a controlled currency, and therefore you need approval to move money in or out of the currency. You've got to go through the regulators, there's banking controls. You actually have to go from Australian dollars to US dollars to Vietnamese dong. And so we've taken let's call it a 2 week process, 1 to 2 week process, down to a 1 minute process. The slippage occurs in terms of the costs where you're converting Bitcoin into, out of Aussie dollars into Bitcoin, but also then volatility in the Bitcoin itself in that 1 to 2 minutes that you might be transferring between the wallets and converting. So there will be slippage there, but in terms of the overall speed and efficiency, when you add in all of the costs that are associated with the traditional movement, it's a fraction of what is being done today.
And so who's making the money in that transaction? Obviously the miners who mined the coin to start with, but who's making money? Where's the profit made in that example we just talked about?
Yeah, I think in that example, when you're talking about a transfer of Bitcoin between countries to act as, a vehicle to take capital overseas, it's the same as any market, and there'll be liquidity providers on each side taking a little spread. The miners will be in there earning their Bitcoin for validating those transactions. And in essence, it operates pretty much like a traditional financial structure, except it's just a lot quicker and you don't really have the middleman. So you just have a lot of individuals out there acting as liquidity providers or miners and creating their own businesses in that area without being able to exert control on the blockchain itself.
Something I might add to that, and it just reminded me of a really good point that Mike and I were talking about earlier, is that if you want to think about blockchain in its present use in quite a simple form, it can do most things that money can do. It just increases the velocity of that money. So don't necessarily think of it as an entirely separate system that you don't understand because it's doing new processes. It's running similar processes to if you wanted to move physical cash around, it just can move it a lot faster. And that's a whole nother conversation around when you increase the velocity of money in the economy, you can intrinsically increase the growth of certain sectors because transactions can be made quicker and money can exchange hands within the real economy quicker.
I think the interesting point you mentioned there was that, you're doing without the middleman. And usually when you do without the middleman, the cost to do things, apart from velocity, the cost to do things reduces. Is that true of a cryptocurrency?
Yeah, I think definitely in this circumstance, it does reduce the costs of transacting and doing all these services, and mainly just because when you have a traditional financial process, maybe where we're transferring money from one bank account to another, there's almost no other alternative. And there are significant barriers to setting up these financial institutions to enable these transfers. And, you have competitors like Western Union charging an arm and a leg just to transfer some money overseas. But with Bitcoin, there aren't many barriers to entry. You can participate if you have a mobile device or a computer and an internet connection. I think that's pretty much the essence of it, that it decentralizes all of the existing traditional financial processes.
Okay, well, we're a little over our anticipated time. I mean, it's just a great topic. And look, I just want to let everybody know that the second webinar next week, same time, is going to be a deeper sort of look at cryptocurrencies, how you can utilize those in your portfolio, things to be aware of, and a whole lot of really good information. Today was really about just giving you background and helping you to come to a certain point so that we can move forward in our exploration of the cryptocurrency and its use in the next webinar. Look, we really encourage you to share this with colleagues and family and friends if you've got people who are interested, and we will be circulating the recorded videos to our clients across the board for anyone who wants to view it as well. So look, I would say there was a very brief slide at the beginning, which was a general advice warning. Clearly, we're not making any recommendation that you should go out and buy PayPal or any other stock or do anything specifically as a result of the webinar. It's very important to get personal advice before you make any financial or investment decisions. So please don't go off and buy something from today's discussion. We really do look forward to welcoming you again for the second part in our series. I noticed that we haven't got any questions other than the ones that I've asked, but if you have questions for our second series, we have one, hang on, it's just popped up there. So we've got a question here from Taylor saying he was wondering how the smart contracts work and if that can be used practically, for example, mortgages, financing, and how would the value of the contract be determined? You know, $1 million home, is it borrowed against the value of the cryptocurrency used or something to do with the blockchain itself? So that's quite a good question.
Yeah, so I think I'll cover that question. So I think that's a really good question. It's a space where when you first look into it, there are a lot of questions because it offers to do so much. So with smart contracts, as I mentioned earlier, there's decentralized finance or DeFi. And within that, decentralized finance aims to provide almost every financial service which you would currently be able to access in traditional financial markets. And that can include, you know, taking out a mortgage. What it does do is it enables individuals to be both borrowers and lenders. And the terms and conditions of these borrowing and lending contracts are written into lines of code within the smart contract. So really you can do anything. You can borrow in a certain cryptocurrency or any sort of digital asset. You can borrow against the value of your home or another form of collateral. One thing which does have to be noted though is that currently there is little legal recourse for smart contracts. So you might have a smart contract that says, hey, you know, I get your home if you don't pay back the loan. But if that property record, recording your ownership of that home is not on the blockchain, it doesn't really fall under the jurisdiction of that smart contract. So until we're able to put property records onto the blockchain, which is a use case which some people are you know, looking into integrating, we won't be able to effectively carry out mortgages and you know, lend against the value of the home. What we do currently see though is that there are a lot of use cases of people just with personal lending and borrowing, putting up items of collateral which can be put onto the blockchain and operating on that basis.
So there's a little way to go in terms of a broader based financial application that is enforceable.
Yeah, definitely.
Yeah, okay. Right, so if anybody's got any more questions now would be a great time to let us know. Otherwise, we will wrap it up for today. And I'd like to thank Tim, Max and Mike for giving us their valuable time, and really looking forward to next week's session. I've got heaps of questions and things to ask, so I'm sure everybody else does too, now that we've gotten through sort of the basic understanding. So thanks very much, guys, at Mason Stevens, and we'll look forward to welcoming you back to the webinar next week to talk further.
Thanks, Sarah. Thank you, everybody.
Thank you.